market is treating like ServiceNow and all other software stocks as if they're going to zero. Is the market correct, or are they presenting us with a golden opportunity to buy software stocks like ServiceNow for great discounts that will give us huge returns for future years to come? In this video, I'll show you in 10 minutes or less why ServiceNow is a great buying opportunity that gives you the chance to get a great company that is going to continue to grow for years that will eventually have the stock skyrocket back. Let's dive into it. So today we'll look at a study that proves out what in the long term is the only thing that matters for a stock price to grow. We'll go into some charts that prove out that ServiceNow is aligning with this exact study that Morgan Stanley had. We'll look at what Jensen Huang had to say about ServiceNow and his track record for what he's had to say about these past AI companies. We'll look at what ServiceNow is projecting for their numbers in 2030, and then we'll run through what my projections look like. So diving into this first chart might be one of the most important ones that you'll see. So what this is it's looking at the stock price and the profitability of a company. Generally, these will both grow at about the same pace. So these lines should be aligning. When you see this disconnect where the profitability is increasing, but the stock price is starting to plummet, that huge disconnect presents a great opportunity for individual investors. In the long run, a stock price is 100% correlated with the earnings of a company. So when you see this disconnect, as long as their earnings continue to grow, eventually the stock price will come back to a more normalized area. One of the greatest investors of our time, Peter Lynch, had this famous quote where he said, I don't think people understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. And that previous chart is showing that exact thing with ServiceNow. There's a huge disconnect between the earnings ServiceNow has and what the stock price is doing. The mask has died, but the show must go on. So, as I mentioned at the beginning of the call, this one study that was done that proved out what were the key drivers for long-term stock performance. If you look out at 10 years, you can see really the only drivers that matter in the long run are revenue growth and profitability growth. So what we're seeing in that previous chart is that profitability is continuing to grow, but currently the stock price is dropping. So there's a disconnect. But in the long run, if that continues, we can see by this study that it should normalize and the stock price should come back up to a more in line amount with the profitability. So we saw in there that revenue growth also was extremely important. So let's dive into that. Looking at a chart, looking specifically at revenue growth and the forward PE. So this is more of how the company is being valued. For ServiceNow, we're seeing, look at this. What a beautiful chart this is. Almost perfectly up and to the right for their revenue growth. But at the same time, you're looking at their forward PE, and it's just been dropping off a cliff. Looking over the past 5 years, we're at the lowest valuation by far, down in the low 20s, while revenue growth is continuing to skyrocket, as well as what we saw on the previous chart, their profitability is continuing to grow up. And keep in mind, their profitability right now is taking a hit due to a couple reasons. One, they just made a couple of acquisitions which temporarily bring down their profitability. And secondly, their stock-based compensation is still a little bit on the higher side, as it is with most software companies. But they've had commentary at their recent investor day that they're continuing to bring that down to a more reasonable rate. So that way they reduce, and I believe their ultimate long-term goal is to keep it flat as far as from a dilution standpoint, since they're also buying back shares. They want to equal that as much as they're offering. And the last thing we'd want to look at is look at the cash compared to the debt. We want to make sure a company has more cash than debt. So no matter what kind of market they go through, they're in a healthy position where if anything happened, they could pay off all their debt and they won't risk going bankrupt. And as you can see, their cash position is well above their amount of debt that they have. So there are no concerns here. Now diving over to something that I saw on Twitter the other day, or I guess X is what we're calling it now. But it was kind of interesting. Now, this has nothing to do with fundamentals, so don't you wouldn't use this as a driver, but it's just interesting how Jensen Huang has called out a couple of past companies that have gone on for huge surges recently that are related to AI winners. And now Jensen has been very vocal about ServiceNow being the AI operating system for enterprise. So, will the history of Jensen Huang being able to call out these next AI winners continue to ServiceNow? I think so, but only time will tell. Now, let's go ahead and go into some projections. So, first up, recently they just had their investor day a couple weeks ago, and what they were projecting out for their revenue by 2030 is $30 billion up to $32 billion. So finally, let's hop into my projections. So here's my base case for ServiceNow. So currently, in their most recent quarter, they did about 22% revenue growth. So they've been consistently over 20%. If we hop back to the revenue chart, we can see down here the CAGR over the past 5 years is actually a little over 23%. So if we're looking at my estimates, I'm not even projecting them to continue that 20% plus revenue growth. I had them down at a respectable 18%. For net income growth, I had them again at about an 18%. I think this number probably can outpace the revenue, but for just my conservative base case, I'll keep these both equal. If they're growing at 18% top and bottom line, a 25 to 35 PE is very respectable. And with this, it gives me a growth rate that's somewhere between 16 and 26%. So close to that 20% clip, which is amazing because if we know anything about the S&P 500, it averages around 11%. So to double the S&P in a base case is a screaming buy. So that's all I got for ServiceNow. Like I promised, less than 10 minutes. So just to recap everything, we showed charts showing their profitability increasing, their revenue increasing, but at the same time, we're seeing a disconnect with the market driving down the price, which in return is making that forward PE the cheapest that we've seen almost ever. And as we know from the past studies that have been done, the key driver for long-term stock price is revenue growth and profitability growth, which ServiceNow has both of these. So with the stock price driving down, this has given us a golden opportunity to get a great company at a great discount. I know for myself, this is a screaming buy, and I've been adding heavy in the start of 2026 to build out my ServiceNow position before the market recognizes this opportunity. So that's all I got for today's video. I hope this was helpful. I hope this got you interested in ServiceNow. Make sure you go out and do your own research, read up, understand their fundamentals, run your own projections. If you like this video, hit that like button. Make sure to hit that subscribe button. Let me know down in the comments what you thought about this video and if there's any other companies that you're seeing this disconnect in as well. I appreciate you watching. I'll catch you in the next one. See you later.